So I have zero exposure to EM. Let me explain to you my view. Following the zero interest rate environment, there's been $10 trillion worth of debt issued by non-U.S. entities, non-bank. A third of that is EM countries. So as the U.S. current account deficit shrinks, it's down to $465 billion right now, 2.2% of GDP, and the Fed continues with quantitative tightening, bringing dollars back. Dollar gets stronger, and these EM countries are going to have greater problems servicing that debt.
Agreed.
Their interest coverage ratios are going to blow out. Their leverage ratios are going to blow out. So that's one of the concerns we have with EM.
EM debt.
EM debt.
Do you think that's not represented in the huge valuation gap and spreads on either the equity or the fixed income side?
There's a difference. There's a difference, though.
There's two ways I'll answer that. The fact that EM just got clobbered by about 25% is indicative of that problem. The second thing is, I don't have to leave fish to find fish. There's great fishing here in U.S. stocks, great growth characteristics, tax reform, strong consumer, everything that I need to invest. We're completely overweight in U.S. equities right now.
Okay, except the fact that you're, again, allocating heavily to U.S. equities in an environment where it's the largest, the most expensive large market in the world. It's been for a couple of years, hasn't hurt anyone yet. But historically, when you look at 5- and 10-year returns, you have done better owning cheaper stock markets than more expensive stock markets.
Well, not in the last 10 years, because the EM delivered over the last 10 years about 3.5% returns annually.
I think it was expensive 10 years ago, though, relative to U.S.
5 years, 10 years, the S&P has outperformed the stock 600. The EM, there's been no better market than U.S. stocks. Now, an argument could be made.
Isn't that driving with the rearview mirror instead of the windshield?
I'm looking forward all the time, but right now, I guess one argument that could be made is, okay, Apple and Amazon accounted for roughly 35% of the S&P's gains this year, and the FANG's 45%. So look, it's a narrow market right now.
Yep, and it's such an important point, Rich, because we've highlighted for so long this risk potentially of like 5 or 6 stocks controlling everything, and people say you're insane. What's
the
that?
Russell 3000 is breaking out. The Russell 2000 is making record highs. A lot of the gains, hold on, a lot of the gains are concentrated amongst a handful of stocks because those happen to be the largest stocks in the world. They're enormous. But it doesn't mean it's a narrow market. It just means a lot of the gains are accruing to a small group.
I meant narrow on the ETF side where
very broad-based rally right now.